Good evening. Good evening. I would like to welcome you guys to the next installment of Ask GMS. My name is Ariel Grant. I am the Alumni Program Coordinator for the Gates Millennium Scholars Program. So this is a two-part series on money management. The second part of the series will air live on September 30th. Ask questions and make comments on social media using Ask GMS. Tonight, I am joined by entrepreneur and GMS alum, Bron Austin Deal. Bron, take it away.
All right. Well, thank you so much, Ariel and GMS, for having me on this webinar. I really appreciate it, and I'm looking forward to being a part of this tonight, and it will really welcome your questions. So make sure you use the hashtag AskGMS. We'd love to hear from you, and the best way that I may be able to help or guide or even answer questions that you may have. As Ariel had said, I was a Gates Millennium Scholar in 2002 to 2007 at the University of Oklahoma. Graduated there with a degree in marketing, BBA in business, and it's been a great time ever since. I am an entrepreneur. I own my own company, and I think it is one of those things that there's a lot more to it than just the basics, and everything is a specific piece of what we will do. So in this, please ask the questions. I will do my best to help answer them to the best of my abilities. So we will start as we go here with our first topic. This is going to talk about money management 101. We're going to go over the basics and use some of the starter points, the foundation, and we'll build from there. I think is going to be the best way to go about it. So as we do that, we're going to cover three basic topics as well as answer questions in between. We're going to try to understand the basics. What does it take to get started? What are our immediate financial or money management starting points? We're going to go over planning for the future. This is kind of where we're going to get into budgets and projections to where we want to go and how we want to get there. And we're going to also talk about being fiscally responsible. As we build with this.
Bron, I'm going to stop you. I think there's some feedback. You may have to use headphones.
Okay. Let me grab some of those. We can plug them in. Give me 1 second.
Guys, thank you so much for bearing with us with the technical difficulty.
I'm plugging in right now.
Can you hear me?
Yes, I can hear you. Feel free to go ahead.
Okay. Well, we have switched to headphones, so please let us know if that does not work better or if that is better. Please let us know either way so we can make sure that we can get to everybody and answer the appropriate questions. Just to kind of recap real again, we're going to understand the basics. We're going to start with that. We're going to move on to planning for the future. And then lastly, we're going to understand how being physically responsible is going to tie all that in together and then move us into where you want to be. And we'll start with some discussion, like I said before, but we'll have Q&A in between. So let's jump over to understanding the basics. This is going to be kind of that starting point. For those of you who may not have been to this point in your young careers and or other careers, we're going to go over a couple little things here, like setting up a bank account, writing checks, the auto pay, debit versus credit cards, and balancing a checkbook. Now, some of you may see this and say, this is very basic. This is too basic maybe, but there's a lot of people that jump past this. They move on a little quick, and they sometimes have to kind of revert back to the basics to understand exactly what it is moving forward. So setting up a bank account is actually a very interesting topic at this point. If it's your first time to set up a bank account outside of one that you may have had as a young person that maybe your parents set up for you or somebody else did, setting up a bank account takes a little bit of information. You have to find a bank that really needs to work for you. And what I mean by that is you find a bank that fits the type of spending or saving or money management that is going to be conducive to the style of living that you're going to have. You want to find a bank that allows you to do your checking as well as a savings. I do recommend having a free checking as well as a free savings if at all possible. Some banks will require minimums that you have in certain accounts to earn some specific interest and or to keep the account alive without getting penalized. And this is the kind of thing that I think you have to look at all the banks to style for you to make sure. Now, this is a foundation piece that can move you into the future. If you can set up with the appropriate bank in the beginning, it's going to make things a lot easier once you move on to bigger and better things as more money becomes available and you start to utilize those funds appropriately for whatever it may be. Now, we all know most banks aren't going to pay you an interest rate that's going to make you rich overnight. And so therefore you have to understand you or that allows your money to be there and to funnel through those accounts may not be the best investment strategy. However, it would be a very good strategy to set up for the future. We mentioned the free bank accounts. If there are ones that do cost money monthly, you want to make sure that works towards you. If there's something there that needs to be required, like let's say there's $1,000 minimum in the bank account for it to pay so much a month or you're penalized. This is something that you want to be very comfortable with. Talk to your banker. Talk about how you use the account. Talk about what you want to do with the account and the potential plans for the future.
We have a quick question. I hate to interrupt you.
Yeah, please.
But someone on social media said, what's the difference between a bank account and a credit union? Also, why get an account rather than just put your cash in a different vehicle?
Okay, good. Well, let's go with the first question first, a bank versus a credit union. The best way to describe this, in my personal opinion, a bank more is a more traditional venue that allows for to take your money and they may invest it or do things outside of that, depending on what type of account you have. When you're setting up a basic bank account, a credit union versus a bank is not always going to really matter for the essential bank account if it's just a free checking account. It may have some different options for different types of it. Like credit unions became really popular with teachers associations or other associations that utilize them because they had certain perks. So if you're part of one of those companies or something that offers a perk through that credit union, that might be wise to take a look at it. I know my personal auto loan is through a credit union versus a bank because my interest rates were lower through the credit union. So sometimes you want to take a look at what they offer across the board. So it would be very wise to look at both styles of that and say, okay, this bank offers this, but they're going to charge me $15 a month to have an account because I'm not going to keep a minimum of $1,000 in there. Plus, if I have a loan with this bank, if it's not a check account, it's a loan account, they're going to offer me 8% interest, but yet this credit union is offering me a better package, no monthly fees, and then potentially 6% on my auto loan or something like that. You look at those across the board and see which one works best for you in the situation. A lot of times companies are teamed up with credit unions, and in that case, they can offer their employees a better rate. So I think without going specifically into every one of them, I think it's going to depend on what you have to offer or they have to offer for you, depending on the situation in which you may be in with the credit union. The second part of that question is why would you put your money in a bank, so to speak, versus another vehicle? I think for the basic account, it's nice to have a basic bank account to utilize for paying bills or using your debit card or check card through the bank account. And we're going to talk about some of those being debit versus credit. But to have that opportunity through a bank, it's the easiest channel to do funds, at least the most traditional channel, and it usually is backed by the FDIC. Now, there are other avenues and vehicles to do so, but some places do not accept funds from those avenues. So I think that's going to be a checks and balances on yourself to say, if I'm going to utilize a PayPal account, for example, or hold money in a different style of account. A lot of them are tied to bank accounts. But if you're going to hold money in a different vehicle outside of that, make sure they're conducive to your everyday spending and or saving. That's very important because you want to have access to your money at all times if you need to utilize it for something along those lines. If you want to ask a more specific question based on a different vehicle, I would have to get a little bit more specific of exactly what we would be looking to ask or talk about, because right now it's kind of a general field out there of that versus a bank.
Right. The question, it goes into a check-in-to-go place. And then the other question that just came to us was, should you ever pay for a bank account? What are the differences, and advantages between a free bank account and those that have pricing attached to it?
Perfect. On the check to go, I'll be honest with you, I don't know enough about that specific company to understand. But what I would suggest is, again, verifying that utilizing that type of an account is conducive to the spending style or the saving style that you personally bring to the table. So if that works for you, where that money, like a direct deposit, is put into an account and that still has access to those funds, then that may be just fine versus a traditional bank. Traditional banks historically have been the go-to. Nowadays, there's a lot more opportunities and a lot more options. And so I think, again, for what best fits your style, if you have X amount of dollars and they're going to be able to help you better with that amount of money, then I think that's something you would have to decide for yourself to make sure that it does fit for you. The second question that I believe was asked there, Ariel, what was the part? We had two separate questions. They were not the same question, correct?
Correct. So the second part was, should you ever pay for a bank account? Are there any advantages for paying for an account, or should you always opt for a free account?
Perfect. And I think that's a great question. Kind of mentioned a little bit before about the differences there, but I would say if you're paying for an account, make sure what you're paying for is going to benefit you. And what I mean by that is there's some accounts that are X amount of dollars per month if you keep a certain minimum or maximum in there. And there's some that you pay for because there's a higher interest rate. It really comes down to how much money is in the account. If you're only keeping $500 in an account and it's going to cost you $10 a month to have the account, if it's not doing anything for you because there's not a minimum of $1,000 in there, I don't think that's going to be your best option. Now, outside of that, if you have $10,000 in an account and it pays a specific interest rate and it has a paid for account, that may be something you look at on what those benefits may be because of the amount of money that's in there. So I think that would really come down to the amount of funds, because a lot of times when you open a bank account, it'll give you a list. They'll say, okay, this is our free one, this is our X amount of dollar, and this is our X amount of dollar. Take a look across the board. When you map those out and set them next to each other, and all banks will do this, see what you're going to be utilizing. Are you going to have so many transactions or deposits? Are you doing direct deposit? A lot of times those things will determine what you're going to get out of the account, and that will show you if it's worth paying for an account. In my personal suggestion, you should never pay for an account unless it's benefiting you. So I would go to the free account unless that paid account directly benefits you due to the requirements for that account. All right, let's move on a little bit here with writing checks. Writing checks is kind of a dead art, so to speak. A lot of people say checks are gone, we don't write checks anymore. However, there are certain times that you may need to write a check. And writing a check these days, you need to understand how to write one, what's the most appropriate way. And a lot of times when you set up a new bank account, they'll even ask you, do you want checks? And most people are opting not to receive them. Because you can always go to a bank and get a blank check or a check for your account, and you can write it on that behalf. There are certain things that you may still write checks for, like paying rent, or maybe it's writing a check to a friend for a $30 option that you purchased. So understanding how to write a check is still important, in my opinion. You always want to make sure that you do write the full amount in the box, because banks will clarify if that amount matches the line item where you write out how much the amount is worth. And there's some ways there that I would go back and look and say, is this really needed for me? But understanding how to write a check is still important. I think young people should be taught how to write a check, even though it is kind of an art that is going away more so than not. Most banks do accept check deposits by their phone. You can take the photograph of the check, and a lot of times you'll still receive checks for certain jobs and or companies that you've set up that may write you a check. Or the last time AT&T happened to get in trouble by the government, they had to write checks and send them to everybody because they overcharged for text and data plans. So there's different things that you understand with checks. Checks are routed to a routing number, which is the bank, and then the checking account number. And so when you write that check, It is basically like using your card, and when you write that check, you give it over. It is as good as cash, and it will go through that way. So I think a lot of people just kind of misunderstand a check, what it may be, and how to utilize check writing for the future. Again, most things are done now through phones and or debit or credit cards, and so the writing the checks has kind of gone away. But at the same time, it's very understanding to know what a check is and how to use it. If there's any questions on that, we can field that. Let's move on to auto pay. Pros and cons here. A lot of times banks will want to set up all your bills to be paid from your account through the bank. In this kind of world, you've got PayPal and Square, and everybody is kind of vying for your dollars, so to speak, on the credit side. And so you want to make sure that you look at things that your bank offers. Is this something that makes sense for you? Because if they can auto pay it out of your bank account, that does take it away from you having to worry about it each month. But make sure that if they're doing that, you might be getting some points on an account. Sometimes they go back to that paid or freed account. Sometimes that paid account, maybe you get more points because you're spending more dollars through that account. And that, really benefits you. And I want people to look out for themselves and make sure that they're getting the best opportunity that's out there. So auto pay, I think a couple pros, again, would be those points and having somebody else take care of it for you. The cons are, if you don't have the money in the bank, or if you're not prepared, if you're on a certain paycheck and it's not in by time, you don't want to do auto pay, because that could cause a backlog in your payment system and throw off your bank account and get overdraft fees and or penalized in the bank. And that sometimes is not going to help us out when we're working on it. Debit versus credit cards. This one we kind of mentioned before. We're kind of leading up to it. This debit versus credit cards is interesting. I'll tell you, when you open a bank account and they give you a debit card, a lot of times it is backed by a Visa or MasterCard. And so when you go to the bank go to purchase something, you swipe the card, it's going to ask you debit or credit. Most people would put debit if they're going to immediately pull the funds out of your account. So you say debit for $10, you're going to see a $10 charge on your account immediately. Now, you might be able to get cash back. It's like using a check, so to speak, when you're using it. That's kind of the way it's kind of replaced a check. But with credit, and you do every purchase, Visa and or MasterCard also backs up that purchase. So therefore, if there's something that's going wrong, it's almost like an insurance. That's what these companies, now you see at a gas station, it says you have to, if you're going to use a credit card, it has to be over $5 or whatever it may be. The reason for that is because they have to pay a fee to those credit companies. And when you pay that fee, that goes as that insurance. So on the debit side of it, a lot of times it's going right through immediately. Now your bank may back certain things up, but I always suggest people to use the credit option because it gives that validity as well as that insurance on something that's being purchased. There's not a difference in the sense of what you're being charged, but at the same time, you want to be protected as much as possible. So if Visa is going to be able to protect you, I would take that as an opportunity. At the end of the day, you have to balance the checkbook. That's our last key here. When you balance that checkbook, you want to make sure that everything is, even if you use a debit card, a credit card, anything that's coming out of that account from that original bank account, you want to make sure that you're balancing that, because with fees and everything else that's out there, you never know when you're going to come across something that it might offset your whole account. And then all the thing, you got a whole different situation. So that's kind of where I would like to put the end of this. Understanding the basics is understanding how to set up that bank account, understanding the daily operations of the bank account, what's coming in and out of the bank account, and really if it's working for you. Is it benefiting you as the consumer, as a customer, to put your money into a program, whether it be a bank and or a third party? Is it benefiting you? I think that's where it is. Ariel, do we have any questions based on this piece?
I think we're good to go. Let me check on social media one last time. Oh, a question just popped in. It says, does using a credit card help to build credit?
They're probably here to give me papers. Okay, I'm sorry, Ariel, say that one more time.
The question was, does using a credit card help to build credit?
I'm not here. Ariel, sorry, it's cutting out a little bit there. I missed you.
I'm sorry, can you hear me now? Am I clear?
I can, yes.
Okay, the question was, does using a credit card help to build credit?
Yes, a credit card does help to build credit. By using a credit card, you'll have a minimum, and on that minimum, it will allow for so much to be paid per month. And as you pay that off per month or pay a portion of that per month, it does give the ability to build credit. And now, as much as it builds credit, I don't know those specific numbers, but it does build credit over a certain amount of time. And so having a credit card is very good. You want to keep a little percentage on the credit card, but not, you don't want to max it out, obviously, and keep it maxed out and pay the minimum per month. That doesn't help with credit as much. That actually could hurt you. But by keeping 10 to 20% on the credit card and paying the rest off a month will certainly help you build credit.
There's another quick question, and it talks to what type of cards. It says, any suggestions on what cards have good point systems like frequent flyer miles?
Say the first part of that question one more time.
The question asks for suggestions when selecting a credit card. Which cards would you recommend has the best point system or frequent flyer miles?
Again, this is going to be specific to your style. So if you're looking for a credit card that's going to give you the most back, some people will choose cash back because that's something that they feel is very usable. If you're going to use the airline miles or points miles, or points with the credit card where you can purchase within the credit card, it really comes down to the person. I mean, if you're somebody who flies a lot, then I would suggest using one that you can definitely earn those miles, because that's going to benefit you directly if that's the style that you're going to be using them for. If it's cash back, then you want to look at a credit card that gives you the most cash back for how, and on that spending, it's going to be a bigger picture. You have to look at what you're going to spend per month to access or to maximize that opportunity.
I think that answers it. Good stuff.
Okay, Ariel, can you give me just a quick second? I have a communication error here. I'm gonna have to take about 20 seconds here. Is that okay?
Sure. And you guys, just a quick reminder, the next installment of the Money Management series will be on September 30th. As always, it will be live. And if you have questions or comments, feel free to use the hashtag at AskGMS. So again, that's hashtag AskGMS. I hope this information has been very useful thus far. We're just covering the basics. So in case you're just tuning in, we went over setting up a bank account. What is that ancient thing called checks? How can we use that today? Auto pay, the pros and cons, debit versus credit cards, and balancing a checkbook. We have some good stuff in store for you guys this evening. Especially with the younger audience of undergrads, when you're getting these the reimbursement checks from your school, make sure you're investing them, make sure you're saving, make sure that you can let it, last. Don't spend it all on consumer goods, have a plan for your money.
Okay, I'm back, Ariel. I apologize.
Thanks. So you guys, I hope, I didn't bore you too much with the recap.
All right, do we want to move on to the next topic? Do we have any other questions that kind of start with the basics that we can move forward with?
There's one last question. What's a good interest rate for credit cards?
Ooh, that is a really good question. That's going to depend on your credit specifically. Generally speaking, you want to keep that under 10%, if at all possible. I mean, obviously, the lower, the better. A lot of times when you open a brand new credit card, they may give you 0% for a certain time frame. You want to access that and maximize your opportunities there. So if you can spend on the credit card and then pay it off monthly, that's going to be your best option for that 0%. So take advantage of that 0% for however long the time frame may be. A lot of times, though, that may be an introductory rate or an introductory to get a credit card with good credit. They may give you that opportunity. If not, they give you anywhere from 5 to 10%. Just be very wise of what you're putting on, because that's the percentage that's going to charge with it. So you want to make sure that you can afford to pay that off monthly, or at least hold a certain percentage on there to build that credit. A lot of times, if you get behind, or if you have a credit that may not be as good to get a certain interest rate, it will be a little higher. However, make sure that if your credit card, if they say they give you a 25% or 28%, maybe you don't have the credit, or maybe that you have not the best established credit. When that happens, make sure that you spend wisely, and you spend enough to bring that down so you're not getting hit with that 25-30% on top of what you're spending. Because even though that credit limit may be $500 or $1,000, you have a percentage there that's going to increase your payments. And by paying the minimum only is only going to prolong and not necessarily help build your credit. It's just going to maximize your credit. And when you go to buy a car or a house or anything, they're going to look to a credit to debt to credit ratio. Debt to income ratio. When that happens, they're going to look at what that debt is. If that debt ceiling is high on all of your cards, it's going to definitely enable a little bit of other options to where you're not going to get the best rates or the best options moving forward to purchase something. All right, let's any more questions, Ariel, before we move on?
No, I think that about covers it.
Okay. Let's start talking about planning for the future. A couple things that we want to start off here. We kind of talked about setting up the bank account and or the money stream to utilize those funds. We want to talk about budgets here. Budgeting is vital to the success for the long term. And I think a lot of people get confused on budgeting when they first set up an account, or even when you're setting up a new account or moving forward. You want to look at what your spending is going to be per month. What are your have-tos? What do you have to pay each month? A lot of times that may be rent or a mortgage, a car payment, things that are the staples, the shelters of your life that you have to have in your daily operations, as well as food and or other entities that fit in that that's the scope of things. So when you build your budget, those are things that have to go in, number one. Of course, you're going to have your income, which is going to most likely be from a job and or other entities that will provide income. But when you take those and you put in your budget, you have to look at, rent. For example, rent never wants to be more than a third of what you bring in as an income. They like to keep rent and or a mortgage underneath that third. Now, if you're a single person and you're doing your budget here, you're going to have the opportunity to take a look at it and say, okay, here's what I have for rent. This is what I have in my car. It might be higher because you're not splitting it or you're not separating it. So these are things that somebody might need to take a look at and say, okay, I've got rent, I've got my car, I've got my my AT&T bill, my phone bill, my groceries, and this is all I have. At the end of the day, I only have $200 or $300 left on each paycheck. That money has to be distributed into entertainment or for fun and or savings. And so when you build that budget, be comfortable with those numbers. Maybe round up versus round down. Keep it to where you have the best movability for you to be comfortable and not overspend. I think a lot of times we get a little excited on credit cards and or loans or whatever we may have, and all of a sudden now we have all these these payments that we have per month or expenses, and all of a sudden they creep up and your income and your expenses are almost equal and or negative. And that's not going to benefit you moving forward. So those budgets are vital to understand where you're at and how much room you have to offer or change anything moving forward. So I think that's very important as that base from everything we talked about earlier on understanding the basics. Now we have to put that budget to work for us and to utilize it appropriately, because it's going to be the foundation of what's going to get us to that next level. And it really give you the option to add or subtract things as we move forward of what you can or cannot afford, which kind of gets into that want versus need. And we'll talk a little bit about that as well. So in the budgets, that's the basis. How can we adjust those budgets? How can we make those budgets work for us? And you want to get rid of that bad debt or that bad negative options that are taking too much money. If we can take out X amount of dollars per month because it's a payment that we've been making for so many years, if we can pay it off a little bit more, say we have an extra couple $100 a month, we pay down that payment, we can get rid of that payment. Now it frees up $500 because we spend an extra $200 a month to get there to pay it off. That's a budget item that now we can open up. Now you have about $700 more a month to work with for whatever it may be, to put towards your future, to save, or whatever we might do. So when you plan your budget, plan it appropriately and accordingly to what is best for you, given the items that you have to pay and or add or subtract to your monthly budget. And I would do it on a paycheck style. So if you're being paid every week or every other week, build the budget based on that paycheck. Or if you do it monthly, that's perfectly fine. But if you're paid bi-monthly, you want to make sure that those line up to where you're matching them. So you understand exactly where you're at, breaking it down to sometimes even down to the day for some people on how much money they can or can't spend. Marielle, do we have any questions on that?
We do. I think this was a question that came in a little bit earlier, but it seems to tie in with this theme. It says, growing up, my family did not manage their finances well. How do I break the cycle of spending and become a saver and stick to a budget?
This is a great question. I can actually relate to this in some regards, depending on the style of living that you grow up in. I came from a single mom with a couple sisters, and we didn't have a whole lot of money. When my dad left when I was 5 years old, it was a very trying time for us. And I grew up always understanding that we never had enough money to cover everything. Hearing my mom or hear somebody say, that. Now, the cycle that I feel like you have to break, or the cycle I feel like you have to understand, is taking what you need and what you are going to do to become better. And in that, you're going to say, again, we're going to build that budget based on what you have to. If there's something you're covering for somebody else in that budget, then I think you have to put that in. But at the end of the day, it comes down to you making the changes for you putting the positives and getting rid of the negatives in the way that your finances, the way you understand finances is growing up. Part of that's going to become you taking control of your finances moving forward and understanding what you need to do to build the plan that's going to keep you from going backwards, keep you moving to the future, that's going to allow you the freedom for financial responsibility so that you can go out there and make some really nice moves. So you can break this cycle by telling yourself, this is what I want to do to plan for my future. I think that's number one. I mean, you take the information that we've already talked about, but number two, number one, I'm sorry, you say that you're going to build the budget for the future and understand where you want to be. Number two, I would say, is making sure that you minimize those expenses or pay them off to those expenses the best you can to understand the longevity. Look at the bigger picture. We may have 12 to 6 or 16 months to pay that off. But after that 16 months, what's the plan moving forward so you can become that saver? You may have no money to save right now, but you may be able to free up some money down the road. Maybe it's only $25 or $30 a month, but hey, that's $25 or $30 a month you can put back. There's no small number. You can always take a small number and grow it into a larger number later. It's making those steps now. Even if you say, I don't have the money to do it right this moment, find the money or associate or the money to where you need to make sure you can move forward. That's a big key for people. I think they always say, well, I'll do that when I make more, or when I get a different paycheck, or when I get my tax return. Not always the case. Find something small now that you might be able to give up and cut that expense to put a little bit money back. It's going to pay off in the long run. Even if it's $5 a month, $5 a month is $60, $60 a year. That's $60, the foundation. That's a piece to start with. And then you have that to move forward. $25 a month or $50 a month, maybe $100, and you just keep growing it the best you can and put it back. And that's going to give you the opportunity to change your lifestyle, as well as understand how to do it. And it's going to snowball. You're going to be able to grow that as you get moving forward and things happen. And maybe
Ron,
that becomes your nest egg.
I'm going to stop you really quickly. One of the viewers just said that they can no longer see your PowerPoint. So you may have to touch your mouse over your computer.
Okay. I did. Did we see anything now, or is that better?
Okay, let's wait for a couple of seconds. If you wouldn't mind exiting out of the PowerPoint and then coming back in. Thanks to you guys again for bearing with us during technical difficulties.
Absolutely. I don't know if you can see me now, but if you can, hi to everybody. I'm back here working on the PowerPoint as we go through. So let's see if we got that. Maybe it timed out. Let's see here.
All right, you guys, we're working through this, so feel free to go on social media once you see him back in action.
I just put it back up. It looks like it's up on my screen. If you can see it, please let us know.
Okay. Still a no. Let's see. Are you guys there in social media world? Let us know if you can see the PowerPoint. It should be displaying planning for the future. Okay, bear with us for a couple of more seconds. All right, I'm hearing that it's still just me.
Ariel, can you hear me?
I can hear you.
Okay. I don't.
Okay, they said you're back, so good.
I'm back. Okay. I'm back, or the
Yes.
or the PowerPoint's back. Which one is
The
back?
PowerPoint's back. The PowerPoint's.
Okay. Well, even better. Well, hey, that sorry about that little mistake there. I'm not sure what was going on. I can see it on my screen, but sometimes we don't know what you're seeing. So we appreciate your feedback. And if there's any other feedback, please let it come in by the hashtag AskGMS as much as possible. We will do our best to make sure that this is open and available to you at all times, and make sure that you can see what we can go from there.
It's keeping us on our toes, I'll tell you that much.
Absolutely. So let's look at the future here and say we've built some budgets, we've got ourselves positioned, we're making small changes to make a better direction for the future, and how can we maximize this? Now, we talked about bank account minimums. So you see that on our screen. We've talked about some of this quite a bit. But when you're planning for the future, you want to make sure, we've also talked about interest rates, you want to make sure that you're getting the best out there that is available. And a lot of times people will start something and then never check in on it. So you now have a credit card that has a certain interest rate, and they may raise it over time due to the beginning interest rate over a certain period. Let's say it was 0%, and then it went up to 10. Or they start with the bank account, and then all of a sudden the bank account starts charging fees after an entry rate. Because there's not enough minimum in there, things like this. These are things that you really need to follow up on. Make sure you're always calling your credit card company for the best rate. It's kind of like what I do for AT&T with my phone bill or my TV bill. Ever so often, I just call them to see what's out there, what's the better rates, or what's the better option. What can I get to lower my rate or lower my options? And 9 times out of 10, you'll find something. It'll be there. And so they may give you a special if you call the credit card and say, hey, you know what, this rate, I need to talk about it. Maybe we need to see where the spending habits have been and make some changes. And that's something that you can only do usually by calling them. I guarantee you they're not going to call you. And so you've got to check in with them as well as your bank, your credit cards, your interest rates, maybe refinancing on a home or a car. These are things that you have to talk to your banker. So what I didn't mention in the very beginning was when you make that a relationship with a bank or an institution or establishment for your finances, make sure you know somebody in that office that you can go to or call and talk to. It's something that's very important because they're going to be able to help you if you have a relationship with them versus somebody on a 24-hour hotline. When you call in, they may not have that relationship or be able to do as much. Never stop from asking. I think it's very important to ask, and it's very important to find out from whether you know them or not. Find out if there's something better out there for you. We talked about bank account minimums. This is something, again, that for certain bank accounts you have to keep a certain amount in your account. For free ones, usually that's keeping it above 0. But there are sometimes you have a bank account maybe you signed up for that you might be getting hit with a small penalty every month because it's not at a certain rate. This is something you can call in and check. Make sure that you're keeping an eye out on this. How much debt is too much debt, or how much debt is bad? Like I mentioned before, you on a credit card to carry a certain amount to build your credit. This is something that you want to have good debt, and good debt sometimes can help build your credit over a long period of time. And this is something that I would suggest in here, that you take a look at. If you have 1 or 2 credit cards, you keep X amount of percent on that credit card, which may be 10, 20%. You pay off the rest monthly. You use it for whatever you do to build that credit. That's going to be very wise for you to build your credit if you have no credit specifically, or if you're trying to build a credit that might be a little bit damaged. Keeping that good debt is going to help the credit. That's where that good debt comes from. Too much debt, though, like I mentioned before, can hurt you when you go to apply for something else. When they look to that debt to income ratio, they start seeing that your debt is, let's say it's 80% of your income. Well, that's not going to help you very much if you're trying to buy a home or a new car. That's going to hurt your interest rate that's going to become available at that time. Good debt and bad debt, again, kind of explained there. You want to make sure now certain things will not be held against you as much. Like if it's medical debt or college loan debt, sometimes those are viewed a little differently than credit card debt or things that are higher with interest rates that might be, consumer goods for what you've been purchasing. So I think that's kind of important to look at when you take a look at everything and you say at the end of the day, I'm holding this much debt because of whatever reason. You have to validate what's good and what's bad. And you want to really get rid of that bad debt as fast, as quickly as possible to make sure that it's not going to hurt you in the future for your future planning and for how you are viewed in the future from your credit options to get the best rates and or potential loans to increase maybe ownership of a business and or to buy property. And we're going to talk about that next. But these are things that you prep for, you position yourself well, and when you move forward, you have a better option available that you can make those decisions without too much. Ariel,
there is a question. There are 2 questions that are kind of similar, so I'm going to combine them.
Okay.
How do I manage bad credit card debt? The other question talked about overspending towards the earlier part of their undergrad with consumer credit cards. And the other question talks about just managing bad debt in general. What are some pieces of advice you can give our scholars and alums about managing that debt if they were too overzealous, years prior and just have tons of consumer debt?
That's a great question. A lot of people come out of college and they've got a lot of debt, whether it be towards paying for college and or in the sense of going to college, or just paying for a lot of the expenditures that come with college. Like maybe it's you had to have some new books and clothing and things of that nature that are justified through your college experience, or maybe you got a little excited because you had those limits for the first time and you maxed them out, and now you're sitting here with X amount of dollars in debt and you have to pay them. What I would say, if you can't pay more than what you can have a month, then paying the minimum is something you need to look at and take a look at exactly what that minimum may be and say, okay, if I'm going to pay the minimum for these so many months, when can I increase that payment? Because the minimum is probably not going to pay off that credit card in the interim or in the short term. So how can I take a look at that, put it into my budget, and then increase it? Now, the problem is if you come out of college and you've got X amount of dollars in debt and you're sitting there trying to build it off of a salary, you definitely want to pay down those cards as quickly as possible, if able, because that's going to open you up with that debt to income ratio that we discussed before. So managing bad debt, what I would say is put it in write down on your budget, write down all the debt that you have and make sure you understand those monthly payments and the minimums. That's what you have to pay. And then you take a look at everything and say, what can I do to get ahead? Which credit cards may work with me? Make sure to call them all. Make sure you talk to them. Make sure you talk to those debts and see if there's some options that you can lower the interest rate or lower the payment, but still get enough payment to pay it off. I think you have to look at them individually, but also collectively, and find out what can be done to get rid of that bad debt and at least pay it down. You want to get it to not the max of each of those cards. So if you're at $500 on a max and you owe $498, it's going to be a lot more wise to pay that down to around $250 of half of that card versus keeping it all at 100% almost of the card's ability. So when you look at that, you have to put that in your budget, and you have to take a look and see, what can I do to make those steps to get those paid down, even if it's one at a time. You say I can only do $25 on each card. Well, maybe you take one card and you pay it down a little bit more as you work out a deal with the other card. So feel free to talk to them and talk to those the debts, and make sure that you're getting the best opportunity you can to pay it off as quickly as possible, or at least pay it down to manage it in the interim until you can find a better solution.
Great stuff. I think that answers the question perfectly. Another question that came in speaks on refinancing, loan options, and consolidation. Any pieces of advice there?
Again, I would definitely direct you to your banker that you have that relationship with, or somebody that might be able to give you specifics in your case. Refinancing or loan consolidation is always an option if you have, it's in the budget and you say, I've got all these monthly payments coming in. I can't keep paying them all because I don't have enough money to spend on my food or my family or whatever it may be. You take a look at it and you go to your banker or your institution and see what options are available to do a refinancing or a debt consolidation loan. This is not a bad option. It's something that you can certainly do and at least discuss with them to try to get yourself positioned to where maybe instead of having $500 or $700 a month in payments individually, you can consolidate them down to a $250 payment. It may take you a little longer to pay it off, but at least you're consolidating where you can manage that payment a little better in the interim until you get back up to where you can look at it as a whole and say, okay, now I can pay them off individually. What I would suggest against is sometimes the debt people that come out and say, well, we'll buy all your debt and we'll write all these letters and we'll basically write it off and you'll pay us X amount of dollars a month. Be very leery on companies like that, because that could really hurt your credit. And if it's something you have to do, then make sure you're getting the best one that can help you with that the most, to help you with not hurting you at the same time, to help you grow that. Now, if your credit has taken a hit and you've got too much and it's mounting and you just can't make the payments, you've got to work with those guys and talk to them individually and say, what can we do? Most of the times they will work with you. Almost 9 times out of 10, they will always work with you. So this is something that you just have to reach out and make sure. So talk to your banker, talk to that relationship, talk to those credit cards, talk to those debt collectors, whoever it may be, and work out a deal that works for you so you can manage it and get back ahead. There's always an option. Somebody will always listen if you just talk to them. Any other questions there, Ariel, that we had off that?
No, we're in the clear.
All right. Well, let's move on to our last slide here. That I think, we got more than one here, but we got one last slide that will help us with the fiscal responsibility of moving on into the future. And there's quite a few things here. And I know we had some questions from Facebook that we are going to try to answer. And some of these are going to be more conducive to this slide or this piece. And how we're going to go into the future, how we're going to become fiscal responsible, how are we going to plan and utilize those budgets and the foundations and everything that we've built so far. How are we going to take that now and grow within our community? Maybe that you've made some very good debt consolidation. You've paid off some good or bad debts. Now you have a little bit of spending money or free money, and you want to invest that to make sure that your future is fiscally responsible. This is that kind of portion where you have that option. Once you get to that piece. So let's talk about your purchases here with credit versus cash. Again, you can always build your credit with certain purchases. And if you have cash on hand and you want to purchase something, it's always a nice option to be able to purchase it outright. You don't owe anything. You're not going to have any interest rates. It's done. That's doesn't happen for everybody. For most people, it's not an option. They have to put it on credit if they're purchasing something large. But to get in the clear, you want to make sure that purchase is the best purchase that is going to benefit you and your finances for the long run. So if you can purchase it in cash, you're going to have a lot more opportunity for that return on investment a lot quicker than that longevity return. If you do the credit option, you're going to have to pay it off. And if you don't pay it off within a certain time frame, they may hit you with rates and certain things that might inhibit you from getting ahead quicker. So big question there. Again, if you're purchasing something large, let's say you're going to purchase an additional home, or you're maybe purchasing another car, a lot of times we have to look to credit to do so in order to be able to afford it. If you're purchasing like a rental home or something along the lines there, a lot of times I would suggest using cash and or leveraging it with a credit to where when you do pay it, it is covering it and you're making a profit on top of that. So if you have a rental home and the payment, mortgage payment is $600 a month, but you know you can get $1,100 for it on a rental property, well, then that's going to cover your mortgage and you'll make a little bit of money on that. And I would suggest using that money you make to pay off the mortgage quicker. So therefore you have more of a cash in the long run when it's paid off. This comes down to having how much debt to carry on credit. We've mentioned that a couple different times throughout this conversation. I think in this specific instance, when you look at debt to carry on credit, when you're purchasing those things to make you fiscal responsible in the future, you look at that debt to that income of what you're purchasing. So if it's a home like we just discussed, it's going to definitely benefit you if the payments are lower and somebody is paying a little higher. You'll have a little bit more money there to free up to purchase things and or pay off what you purchased a little quicker. Worth versus want. This is something that I like to mention to young people is a lot of times in the very beginning when you have that ability to purchase things, you really need to look at stuff that is going to benefit you over the long run. What I mean by that is what there's certain things that we want, and we, of course, if you want certain things and you have the money, it's nice to be able to buy something simple and to help yourself out and say, you know what, I've done this right. I can purchase this new pair of shoes or a purse, or maybe it's some games tickets to a football game. Those are things that we can do, but you have to look at your finances and say, is this something that I really need? And that's not on the screen. It's not worth versus want versus need. But when you start to look at the worth, is this something that's going to benefit me? A lot of people ask me how I can start off by investing a small amount of money and growing it over the long term. And I tell people that life insurance is a key factor there. When you're young and you're healthy, you can get life insurance policy that's really going to benefit you in the long run. And when you get that life insurance policy, you look at a permanent one versus a temporary one, or what they call term versus permanent. And when you buy into a life insurance policy, specifically with a permanent one, and you put $50 to $100 into it a month, it has a cash value, and over time that grows. And so I'm not a financial advisor, so I can't specifically tell you which one works for you, but I have the capabilities of connecting you with the appropriate people who can. And so when you look at the little things that can make those steps, sometimes life insurance is one that is very available and that you can utilize appropriately to make sure that you're putting your money where it's going to grow over the long term versus some of the other investment strategies. Investing in your future is key. What can I put towards a month that can, you can always save a little bit of money here or there. That is one option. It may not grow as fast, but why not take a look at some of the options that do? A couple things in a book that I would suggest reading is Rich Dad, Poor Dad. This is a book that's highly talked about. It's one of the best-selling books of all time. And Robert Kiyosaki, the one of the things that he says in there is invest in a property or business that's going to give you passive or portfolio income. That's really what we were talking about earlier. When you try to free up your space, you've got certain things taken care of and leveraged. Now, how can we invest in something that's going to be able to grow? Well, life insurance is one way to do that. It's on a smaller level. And that's something that I think when you get older, you look back and you can't get life insurance due to health reasons because it's not viable. But you take a look at what can help me now, and you look at those things that are available on a smaller scale. This is where I would really suggest getting a financial advisor and talking with them, getting on a plan with them, making sure you pay out those bad debts or those debts that you need to get paid off, and you start looking at things that can benefit you for the future. This is very important. So please, we're going to give my contact information here in a moment. I would love for you to reach out to me individually. I can talk a little bit more specifically on that. On a general webinar as we are now, it's very difficult to talk specifics because there's so many options that are built on what your needs are. And so I know we have a couple questions here on this, and Ariel, do you want to ask them, and I will try to address a few before we're at the end of the conversation.
We have 3 questions here. The first one on this topic is, what are safe methods to invest smart? Can you describe any means for a new investor if they want to get their feet wet. How should they go about investing for their future?
Okay, I would say a couple things. I'm not a big fan of the online or the what's the best way to put them? The ones that they want to give you some options. You pay a certain fee per month or what they invest in. Those are very difficult because they're almost reactive versus proactive to the markets, and so a lot of people will buy into a program where somebody's managing some funds for them, and they're buying, oh, I want to invest in this, and this, a 401k. These are options, not necessarily 401k in that specifics, but 401k is a lot of times available to people. It's a long-term, maybe your company matches it. That's a safe way to invest because maybe your company matches it up to 6%. So if you put in 6, they put in 6, that's 12. That's a nice way to put in some funds that are more safe than not. Over a long period of time. But keep in mind with the stock markets, the trends are on 12 years. So you're not going to get rich quick. So these are things that I think people have to understand. Those are safe bets over the long haul. If you're looking at something that you want a little bit more control over or something that you want to play around a little bit more with, then I think you have to go to a financial advisor and talk to them about those in those individual markets. A lot of those mutual companies can look at those mutual and they invest to where it's going to maximize your opportunities because you have somebody watching them every day. And that's something that I would definitely suggest reaching out to me. If that's something you want to talk about, I can put you in touch with somebody, but be careful on safe things. I mean, like 401k is fairly safe and companies offer it. And it's a great little savings plan. But when you start looking at safe things in investing, there's nothing that's ever really safe. I mean, you are putting your money out there to hope that it'll grow. The safer is going to be over the long haul, not the short haul. Your short haul investments are going to be a lot more risk and reward. And so you put this in football terms, you have an offense or a defense that likes to press the other player and try to get interception to score or turn the ball over for the defense. That's not a safe bet all the time. That's man coverage. Zone coverage is going to be more of the safe bet. Man coverage, you're having that higher risk, high reward. So depending on what you want your money to do, is going to be a question that you need to sit down with somebody and talk about. I really feel like that's conducive to your future because it's going to give you the best moves for what you have. And depending on how much money you have to do so, that will dictate that.
Great stuff. Here's the next question, because I know we're running short on time. It says, if areas like real estate and other high investment capital areas like that are safe, smart ways to get started, what about if you only have a couple of hundred or $1,000 or $2,000? What are some investments that you can use with smaller capital?
Yeah, again, this is a question that I would talk to a financial advisor specifically on, but a couple hundred to a couple $1,000s. There's some options to do some group investing where you're a portion of a larger pocket of money. And so your money goes in with others and it works for you that way. I say that those are some options that you can look at, again, through a financial advisor. Not through just I would not research it online, just buy into an online company. It would advise against that. But real estate and REIT investments are very safe in the long run. A lot of times they take a little bit more money to get started. So if you're buying into a property specifically, that does give you a lot more flexibility if you have the funds to buy into it, or the cash value. A lot of us aren't at that point in our lives yet. So we have to look at smaller things. What I would say is the best way on the couple $100s and things like that. Again, I don't want to keep selling a life insurance policy, but the life insurance policy are a lot more affordable for a couple hundred to a little bit more. And that life insurance policy could open you up to other investments with a mutual company. And in that, you have the ability to maximize those funds versus having to try to get more funds to get a bigger investment. So take a look at, again, meet with a financial advisor if you're at that point in your career or life, and let's talk it out with them and find out what's best for your case, because I really want you to have the best options that are there forward.
Thanks you guys again for sticking with us. There's two quick more questions and then we're going to wrap up. The first question is, how big should my emergency fund be? And the last question is, would you recommend money management apps like Mint.com?
All right, I'm going to put it on the last slide here so you can get my contact information. Feel free to reach out to me via email, LinkedIn, or Facebook. That's my professional Facebook page, so feel free to like my page and definitely reach out questions individually. I'll do my can to help you. So on those two last questions, the apps and things like that, again, I really would advise against them because I don't know that they're the best for you. I would talk to a financial advisor to see what kind of money you're putting out there before you just throw money into a management app. There's so many different options, and this is not, if you're not a normal investor, if this is not something that you do on a normal basis, you're really taking a risk that I don't know that I could verify for you, because you're putting a little, and they may have smaller amounts of money and they may have some success stories, but so does gambling. You know, gambling has that same kind of thing. Of course, it's going to work for some people. It doesn't work for everyone. So be very wise. Read up on it. Read reviews. Do your research is what I'm saying. As far as your emergency fund, the best way to do that is you want to have a full 12 months. If you have a budget, you want to have a full 12 months. Most of us can't even get close to that, but that's what they would tell you, is have a full year, because it takes at least 6 months to find a new job in most cases. So 6 months is that second part of that, 6 months to 12 months. But most of us, I would say, is try to have something between 1 and 3 months saved up so that you can live immediately before you can find something else. If that's the case. So 1 to 3 months is what I would suggest immediately. 6 to 12 months would be a little bit more of a bigger and better plan. So take that. Read Rich Dad, Poor Dad. Read some books by Susie Orman. She's amazing. Dave Ramsey is another great writer as well. These are people that can really benefit you to get debt free and to live life to its fullest.
Well, thank you so much, Bron. I'm really excited for your tips. For all those who weren't able to join us, feel free to watch us on playback on YouTube. Again, absolutely. I'm Ariel Grant. This is the first of a 2-part series. If you have any lasting questions for us, ask them on social media using the hashtag AskGMS. And we look forward to seeing you at the second part of this series on September 30th. Thank you guys for tuning in.
Thank you.